The year 2023 was remarkable for the Indian automotive sector. It saw an unprecedented surge in vehicle sales. While families upgraded to new vehicles, auto enthusiasts reveled in the new models offered by automakers. The annual volumes of cars, sedans, and utility vehicles breached the 4 million mark for the first time in 2023. This was an 8.2% increase from 2022, where 3.79 million units were sold. In a sign of increasing annual vehicle sales, data available on the Vahan portal as of 31st December 2023 showed registrations were up more than 11% in calendar year 2023 as compared to 2022, which saw 21.5 million units being sold. The sale was around 23.9 million units, marginally behind by 1% when compared to 24.17 million in 2019. However, beneath the hood of this positive sentiment lies a growing concern: the surge in inventory levels for passenger vehicles. It is crucial to note that the sales figures of automotive manufacturers only reflect the quantity of vehicles passed on to dealers. According to the automobile body, Federation of Automobile Dealers Associations, or FADA, the year 2024 began with the passenger vehicle inventory at 650,000 units at the dealer level. And this inventory pent-up is not new. It hit an all-time high in August last year. Even during the festive season of 2023, when sales were robust, the PV inventory was stacking up. FADA President Manish Raj Singhania in November had said inventory levels for passenger vehicles remain a significant concern as OEMs continue to push further dispatch, thus keeping the inventory rate at near to all-time high levels. In October 2023, the inventory ranged from 63 to 66 days. As for November, just after the festive season sales, the average inventory of passenger vehicles ranged from 61 to 63 days. FADA noted. It dipped to 55 to 58 days at the end of December. Maintaining inventory beyond 30 days is believed to erode profitability for dealers. This is due to the financial burden brought about by the high interest costs of inventory funds. So, Puneet Gupta of S&P Global Mobility explains the dichotomy between record vehicle sales and the growing inventory.
We entered 2023 with a very, a high pent-up demand. So there was almost waiting period for almost most of the cars, which really, helped 2023 volume because, somewhere you may not be able to see that waiting period, which actually has been translated into retail sales. If we go back almost 1 year, the dealer inventory was around 35 days, whereas generally before pandemic, it was roughly around 50-55 days. But now, in 23 December, so basically the inventory went up to the level of around 65-70 days. When the inventory went up, we saw heavy discounting, because generally every dealer would like to revolve his working capital. But for most of the models, most of the industry, so the pent-up demand is over.
To add to the woes, PV sales in 2024 are expected to start on a weaker front due to the Kharmas period, during which the demand is anticipated to slow down, according to FADA. It has given a cautious optimist outlook for the year, emphasizing that the inventory pileup and effective supply management need to be worked out. Analysts believe that auto manufacturers, in their eagerness to meet the growing appetite for new vehicles, have inadvertently flooded the market, leading to surplus inventory. With record demand in 2023 for PVs, OEMs continued bringing newer models and upgrading existing ones. Also, in the excitement to cut short the waiting period for more sales, dealers stocked up on more units. So, how can the industry deal with the inventory problem?
Yeah, so you see there are two extremes here. There is an agency model where dealers carry zero inventory. Okay. And there is stock and sell model where dealers have to carry inventory. So in agency model, the OEMs like Mercedes, they have decided to have an agency model. Dealers have no inventory, right? But agency model takes away a big role of the dealer, right? Dealer is a stocking company and a selling company. Dealers will love 30 days, OEMs will love 60 days, but nowhere in the world we have 30 days. 30 days is an unrealistic expectation because you have how many models and variants you have to cater, right? There are more than 1,300 variants. So you have to keep the color stock, you have to keep the choice to the customer. So I think 30 days is a bit too ambitious, and that will lose a loss in market share for car companies. Ideal is about 45 to 50 days.
While discounts and promotions can boost short-term sales, they can also impact profit margins and brand value in the long run. The industry must strike a balance between meeting immediate sales targets and maintaining a sustainable business model. Auto experts believe that the imperative lies with OEMs and dealers to collaborate closely, employing strategic measures to maintain equilibrium between supply and demand.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.